Namaste. Good morning. So we understood this format now completely. Now we know what is opening WDV, additions, why we are dividing into two, what is addition, what needs to be recorded in special circumstances, deletions, normal depreciation, additional depreciation, and the final answer is closing WDV. But technically, the answer is always the total of depreciation. The total of depreciation. So far, we have seen 4 case laws in depreciation. A. Sivakami and Co. Beneficial ownership. ICDS Limited. Lessor only uses the asset, so he can claim the benefit of depreciation. By giving it to lessee, lessor uses the asset. BSES Yamuna and Federal Bank. Okay, where what is an accessory and what is the standalone instruments. EPA BX and mobile phones are standalone aspects, whereas printer and scanner are accessories which will get the eligible depreciation of 40% as like computers. So these are all the case laws we have so far seen. Okay. Ending this discussion with another case law which is not our recent case law, but this case law is a continuous case law, which means there are enough number of questions even today asked in this. Will replacement constitute a new asset? As simple example as a painting. First time I painting my office, it is a capital expenditure. Subsequently, when I paint, it is just replacement. And this concept can go to a bigger extent. Tools and dies in TVS Motors case, they said, first time you make the mold, that is a capital expenditure. Subsequently, you replace it. Okay, it is a revenue expenditure. Okay, a hotel had a carpet in their reception. They replaced the carpet. It is a revenue expenditure. A new asset is not coming into existence. Only replacement happens. TVS Motors. Replacement does not bring a new asset into existence. Replacement does not bring a new asset into existence. Hence, the cost of replacement shall be claimed as a revenue expenditure. Hence, the cost of replacement shall be claimed as a revenue expenditure. Okay. Taking this opportunity, a small recollection of whatever case laws we have studied so far in PGPP. Chennai Properties and Investments, Rayala Corporation. In all those cases, we said if the property is let out for commercial purposes and it's there in the main object and the substantial revenue arises from it, then it will be considered as PGBP and not house property. Gujarat State Fertilizers and Chemicals Limited, where we said that subsidy received instead of, or bond received instead of subsidy, The loss or profit on sale of bond will be treated as business expenditure. K and Co. Margin money. Okay. For obtaining bank guarantee, the interest on such margin money is a business income, whereas surplus fund is a IFOS. Uh, Sri Rama Multi Tech. Okay. Where we said that share issue expenditure can be adjusted against the interest earned on application money kept deposited. A. Sivakami, ICDS Limited, Federal Bank, BSES, and TVS Motors. These are all the case laws we have so far seen in PGPP. We are moving ahead. Okay. The heading is concept of unabsorbed depreciation. Concept of unabsorbed depreciation. Listen, friends, listen. I am taking a P&L account. Okay. My gross profit is 40 lakhs. My operational expenses is 35 lakhs. And I have a depreciation of 15 lakhs, resulting in net loss of 10 lakhs. Resulting in net loss of 10 lakhs. Under income tax law, this net loss can be carried forward as unabsorbed depreciation. Why? Before charging the depreciation, I had profit. I had profit of 5 lakhs. The reason for my loss is depreciation, where the profit available is not sufficient to cover the whole of the depreciation. The uncovered portion of depreciation will be carried forward as unabsorbed depreciation. And I have an example too. Suppose if my OPEX itself is 45 lakhs and my depreciation is another 15 lakhs. So I result in a net loss of 20 lakhs. Now, business loss is 5 lakhs and unabsorbed depreciation is 15 lakhs. Do you understand this? Do you understand this? Okay, right. Take up these two examples. We'll write the theory. Listening, friend. I'll do one thing. I'm sharing the screen also, so that should be taking care of the full. Now you will be able to see. Can I? Is the class understanding this? I'm going into the theoretical explanation. The greatest advantages include it can be carried forward and set off against any income carried forward, even if return of income, belated filing of return, and it can be carried forward for an indefinite period. Can I? Can I? Okay. Shall we? Shall we, Srinidhi? Srinidhi, what is succession? No? Good. Very good. Yeah, amalgamation. Yeah. And conversion. Succession means three things apart from inheritance: amalgamation, demerger, conversion. Conversion also has three things: firm into company, sole proprietorship into company, company into LLP. Okay. No, company into firm, not possible. Company into LLP. Now, I'm looking into a concept of proportionate depreciation. Concept of proportionate depreciation. So, you will immediately ask me a question. You said in the first class, there is no concept of proportionate depreciation. There is no 7 by 12, 9 by 12, 3 by 12. It is only divided into more than 180 days or less than 180 days. So where is this question of proportionate? I still hold good. There is no concept of proportionate depreciation under income tax law. This concept is not computing proportionate depreciation. This is distributing the computed depreciation. Repeating, I am not going to speak about computation of depreciation on proportionate basis. That is never a concept under income tax law. I am only going to speak about distribution of computed depreciation. When should this happen? When two entities want to claim depreciation for the same asset. When two entities are eligible to claim depreciation for the same asset, compute depreciation, distribute it proportionately. Okay. So, X limited amalgamated with Y limited, let us take that it completed today. Let us take that the entire transaction completed today. So what happens is, X limited has been using the asset till 9/10. From 10/10, Y limited is using the asset. How to claim depreciation? Law says, forget that something like amalgamation happened. Forget it. Compute depreciation as if nothing happened. Compute depreciation. Such computed depreciation will be distributed between the entities on a proportionate basis. You're understanding? Okay. You're okay. This is applicable in the case of succession. This is applicable in the case of succession. I believe I need not repeat succession. Somewhere you have written what is succession. You have put a map on what is succession. Amalgamation, demerger, all types of conversion is known as succession. This is applicable in case of succession, where two entities need to claim depreciation on the same asset. Then depreciation will be computed by ignoring the event. Then depreciation will be computed by ignoring the event. Such computed depreciation will be distributed between entities based on effective usage period of the asset. Such computed depreciation will be distributed on the basis of effective usage period of the asset. Is it clear? it will be distributed on the basis of effective usage period. How many days each entity is using the asset, and it is not computed on months or weeks, it should be computed on number of days. Shall I, friends? To your practical note. Page number 14, question number 8. Smriti Limited has a block of asset carrying 15% rate, whose written down value is 40 lakhs, purchased another asset, second-hand asset, on the same date, on the same day block, for on 1st November for 14 lakh 40,000 and put to use on the same date. Smriti Limited amalgamated with Shruti Limited with effect from 1st January. So the amalgamation is effected to from 1st January. Compute the depreciation that Smriti and Shruti Limited can claim, assuming asset was transferred by Smriti Limited to Shruti Limited for 60 lakhs. Read. May I? Okay. First, let me write to you a theoretical answer. According to section 43, the transferee company can record the value of asset okay, the transferee company can record the value of asset as it was prevailing in the books of transferor company. Hence, Smriti Limited cannot record rupees 60 lakhs as the value of asset. Okay, the first thing you have to understand is I can only record the value at the WTV. That's what we know. So it cannot be recorded at 60 lakhs. May I, friends? May I, friends? Now I require your full attention to understand this concept. I'll write the theory again here. The computed depreciation will be distributed between the entities based on their effective usage period of asset. Shall I? Shall I? Please understand. Please understand. Take your time in understanding this. For the asset in the opening balance. For the asset in the opening balance, Smriti Limited would have used it till 30th of October. Till 30th of October. You are all clear? Smriti Limited would have used it for till 30th of October. Okay. 1st April to 31st October. Okay. So 30 April plus 31. Can you please do in calculator? April 30 plus May 31 plus June 30 plus July 31, August 31, September 30, October 31. 214. 214 days. And for Shruti Limited, 365 minus 214. 365 minus 214. Okay, November to March. You're all clear? Okay. Interestingly, for the asset, sorry, it's up to 1st January. Sorry, this is, I took the asset, sorry, up to 1st Jan. Up to 1st Jan. Another 214 plus November 30 plus December 31. 275 days. Here it will be 90 days. For the asset purchased on 1st November, 60 days, 61 days, 90 days. You are all agreeing? So the most important concept in proportionate depreciation is number of days of effective usage. I purchased asset only on 1st November. Don't worry about this while computing depreciation. Compute 7.5%. That 7.5% depreciation will be distributed on the basis of effective usage period. Okay. Right. Depreciation on opening balance So it comes to 6 lakhs. Friends, 6 lakhs into 275 by 365. Five zero. Is it 52 or 50? No, that's the third digit. 4,50,000. 0, 52,000. 0, 4, 4, 5, 5, 5. Okay. Here it will be 6 lakhs minus 4,52,055. Depreciation on asset purchased in November, 1,08,000. So here it will be 1,08,000 into 61 by 151. Total number of days is 151. Take down. Any doubts? Shall we move on? Shall we, friends? Yeah. Bhargavi, you got it. Yeah. Online friends, you got it? Pushpak and Co., a partnership firm, was converted into Pushpak Private Limited with effect from 1st November. However, the company commenced the business and started to use the asset only from effective usage period. For company is only 31 days. For company, it is only 31 days. That's where the question is important. That's where the law makes it effective usage period, and you need not worry about it while computing depreciation. The opening WDV of plant and computers are 2640 On 1st June, plant and machinery was purchased for 1990 and immediately put to use. No further investments were made. Compute eligible depreciation for the firm as well as the company. Ignore the additional depreciation. Okay. Only the normal depreciation. Go ahead and start working. 214. 153. Just confirm me. If at all there is a mistake, please let me know. Which part of it you're getting it? Which part of it is the depreciation, right? 396 is the total depreciation, correct? 396 plus 444 comes to 8 lakh 8,40,000. In the first case, 8,40,000 into 214 by 255, right? 214 plus 31 days. Total effective usage period is not 365. The total, I would have computed depreciation. While computing depreciation, forget I am going to distribute. While distributing depreciation, forget the computation. distributed only on the number of effective usage days, which is 214 plus 31. We never said from March to uh, while computing, we never checked whether June to November, what is the depreciation, etc. We computed 15% on the asset purchase. At the time of distribution only, the concept of proportionate comes. And the law has used the word on the basis of effective number of days used. So we have to do only on depreciation for electricity company. Depreciation for electricity company. Okay, right. Do we remember something about this? Very nice. Very nice. They have the benefit of claiming SLM also. They can choose. The choice has to be made before filing the first income tax return. Where they are claiming SLM, no block of asset. Individually, every asset has to be depreciated. No additional depreciation. Power sector is also manufacturing. So it will not qualify for additional depreciation. So these things makes them automatically fall under WDV, that is diminishing balance method. I don't think anybody follows, just theoretical concept. These companies have the option of choosing straight line May I, friends? May I? For a minute. I purchased an asset for 10 lakhs, whose WDV now is 6 lakhs. It is getting sold, okay, for 4 lakhs. The law says terminal depreciation is 2 lakhs. It is getting sold for 8 lakhs. The law says income, that is balancing charge, as 2 lakhs. It is getting sold for 11 lakhs. What happens is balancing charge is 4 lakhs, capital gain is 1 lakh. Totally we know that is 11 minus 6, 5 lakhs is the gain divided into 2. Okay, that's what that theory means. Do not even worry about this. Not seen a question. As I told you, nobody follows. Okay, you should not get confused when you refer to the material. So that's why I have provided. Forget this. I mean it. Forget it. Okay, right? That brings us to the end of our depreciation discussion. What did we discuss? We discussed how to record cost of addition. In that, I want you to remember 43A, forex difference, borrowing cost. Both are very popular adjustments. We then saw special cases, second-hand asset, building used, foreign branch to Indian, already used asset, now building used, now brought into business, like that. Then we understood normal, additional, proportionate, unabsorbed, and depreciation for electricity company. Am I clear to you? Okay. Right. We started with section 30 to 37 are uh, expressly allowed by law. In that, the first three are asset based. 30, expenses in relation to building. 31, expenses in relation to plant, machinery, and furniture. 32, depreciation, the long term. We are stepping out of depreciation to section 33. This section is known as plowing back of profits. Plowing back of profits. After earning profit, an entity has two options: retain the profit in the business, distribute it as dividend if it is a company, take it as drawings if it is a firm or sole proprietor. This section is going to motivate you to retain the profit in the business and use it for your furtherance of business. And interestingly, this section is going to give deduction for deposit made in a special account. Okay, deposit based expenditure of deduction. This is for plantation sector. Okay, tea development account. Three falling branches, my dear friends. Available for growing and manufacturing. Available for growing and manufacturing tea, coffee, rubber. Okay. Deposit has to be made in development account. Deposit has to be made in development account within 6 months from the end of the year. Okay. Deposited money should be used for purchase of assets to be used in field activity. Deposited money should be used for purchase of asset which needs to be used in the field, agricultural field. Only office asset which qualify is computers. Other than computer, everything should be like tractors, irrigation equipment, like that. Such asset not to be transferred for a period of 8 years. Am I clear? Okay. Deduction will be actual amount deposited or 40% of profits, whichever is less. Is it clear? Okay. Actual amount deposited or 40% of profits, whichever is less. Consequences. The term consequences is always negative if you violate the condition. Okay. If the amount deposited is not utilized for specified purposes, then it becomes taxable in the year of violation, withdrawal. I withdraw it, but don't use it for specified purposes. It will become taxable in the year of withdrawal. Exceptions are liquidation, partition, and death of assessee. Exceptions are liquidation, partition, and death of assessee. Liquidation is for company, partition is for HUF, and if it is a sole proprietor, on death, withdrawal will not be taxable. Where the new asset is transferred within 8 years, then the exemption already provided will be withdrawn. Clear? Clear? Okay, read it once. So this is available for plantation sector. And if you don't plow back your profits, if you plow back your profits, if you don't distribute it, keep it deposited in a separate account, your profit. Up to 40% of the profit, I will give you deduction. The deposited money, use it for purchase of asset in the field activity and do not transfer it for it. If you withdraw the money but don't use it for purchase of specified asset, then in the year of withdrawal, I will tax it. However, 3 cases of withdrawal not taxable are liquidation of a company, partition of HUF, death of a sole proprietor. Where the new asset which you have purchased is transferred within 8 years. Whatever exemption I already gave, I will now tax it. Am I clear to you? Am I clear to you? Right. Available only for assessees who are engaged in the business of growing and manufacturing tea, coffee, rubber. Okay. Does this ring a bell within us? I know it's very difficult to catch hold, but is there something which triggers you? Yeah, louder. What do you mean by that? Yeah, that's what growing, manufacturing, all those things. Another is, huh? Uh, I take that answer, and I believe what she's hitting it. In all these cases, a part of the income is only business income. Another part is agricultural income, which is not taxable. In all these cases, my dear friends, a part of the income, all these three plantation sector, rule 7, 7A, 8 also always says a part of the income is business income, part of the income is agricultural income. Let's write that. Okay. Subdivision of income. So coffee and tea 60-40, rubber 65-35. Repeating, coffee and tea 60-40, rubber 65-35. Only if it is a raw coffee 75-25. Raw coffee is rare. Everything has to be roasted and grounded also. Okay. Raw coffee means directly you are plucking and selling it. Okay. But if you find some more process, that is roasting and grounding, 60. So coffee and tea 60-40, rubber 65-35, raw coffee alone 75-20. Major part is agriculture. You're clear? Any doubts, friends? Shall we move on? Okay. Whenever you find time, do 10, 11, 12. Okay. Just the same questions. Anyhow, when you get the full material, you will get the answers also. I'm in page number 17, question number 12A. I'm in page number 17, question number 12A. Saplings are fully no agriculture, that is tree saplings, this small things which they sell. If you go down the ECR road, you will find lot of nurseries. They call it as nurseries where they sell tree saplings. Okay, which is fully agriculture, not at all taxable. Okay, if you are a gardener, plant lover, okay, please excuse me for 2 minutes. Okay, sometimes when you go to wedding, they give you that. You don't know what to do. Actually, I'm not a very big gardener, or I don't know what to do if they, sir, this special tulsi for you, sir. How to take it back home in my bike also, I don't know. And coming back also, how to preserve, I don't know. I used to tell them, sir, some gardener, no, sir, this is specially we have kept it for you. Please start doing this. Question 12. So the third one, I read it again. Income from sale of coffee grown, cured, roasted, and grounded in. So entire thing is business income. Entire thing is business income. Remember, just check whether the totals are right. Is it clear, friends? Is it clear? Please, these are partly agriculture, partly business. I'm going into question number 14. Dinesh, an individual, is engaged in growing and manufacturing of tea in India. Are you all following online, friends? Maitli? Yeah. Dinesh, an individual, is engaged in the business of growing and manufacturing tea in India. For the year, his business profit before allowing 33 AB is 60 lakhs. On 1st September, he deposited a sum of 11 lakhs in tea development account. During the previous year, 24-25, he has a loss of 14 lakhs, which has been carried forward. Determine the business income, agricultural income, and tax payable for the year. Income before allowing 33 AB, 60 lakhs, less expenditure under section 33 AB, 40% of profits, which comes to 24 lakhs. Okay. Actual amount deposited, which comes to 11 lakhs. Whichever is less is going to the outer column, 11 lakhs. Please check it out. Remember where to reduce the loss also. After computing business income only, the brought forward loss will be adjusted. Don't worry about tax. We'll do when we do agriculture income as a chapter. I'll tell you how to aggregate the agriculture income. As of now, don't worry about tax. Just the income. May I? May I? Okay. Part B of the question. On 25th Jan 2027, in the financial year 26-27, he withdrew 10 lakhs, which is utilized as follows. 6 lakh for non-depreciable asset as per scheme allowed. 3 lakh for purchase of to be used in office premises. 1 lakh other expenses. What will be the treatment? So this 4 lakhs will be taxable in the financial year 26-27. Clear? Clear, friends? I'm going to part C of the question. What will be your answer if the machine that is purchased for 6 lakhs is sold for 8 lakhs? Okay. Asset purchased using the deposited sum should be held by the assessee for a minimum period of 8 years. For a minimum period of 8 years. Where it is transferred within 8 years, the exemption already granted will be withdrawn. In the given case, rupees 6 lakhs purchase value of asset will be treated as income in the financial year 28-29. The sale value over and above the original cost is taxable as capital gain. May I? Can I, friends? Can I? Back to our theory notebook. Go ahead with your doubt. Once more. No, no, it will not be a capital loss. Whatever is the asset sale value will not be given as a capital loss. It will be considered as your exemption is withdrawn. That's all. Friends. The next section is 33 ABA. Site restoration fund. For oil and natural gas. The two differences are it is for oil and natural gas and the profit to the extent of 20%. All others are same like 33A. All others It should be within 6 months kept deposited, and it should be used for asset for field activity computers. Do not sell the asset for 8 years. Do not withdraw. All other conditions are like 33A. Am I clear? Okay. Having said, I haven't seen a question in 33 ABA. Only 33 AB is important. Okay. 33 ABA, just ignore it. So, friends, there are two deposit based deduction, one for plantation, one for oil and natural gas. Okay. That is section 33. Section 34 is not there in the law itself, leading us to section 35. One introduction which I gave you long back, I am repeating. If the law wants to give deduction as a percentage of asset, they will make it fall under 32. If the law wants to give the asset itself as a deduction, 35. In almost all sections of section 35, we are going to see the whole of the asset cost can be claimed as deduction. We'll take a break, come back and start. Before going into 35, I need to end this with some other note also. Deposit based deductions cannot be claimed under concessional tax regime. This is not for you to write. This is for you to just follow. That's all. Not for you to write. Section 35 is actually going to be divided into 4 parts. Scientific research expenditure, which is there in the core section 35. Specified business expenditure, which is going to be 35 AD. Amortization, claiming an expenditure in multiple installment, not just in 1 year, in multiple installment, and social welfare deductions. After completing, we'll come back and pick it. Okay. Section 35 has 4 parts. As like 32, 35 is also a long travel section. We start with section 35, scientific research expenditure. Okay. Advancement of knowledge, in the field of applied natural science, including social studies and statistical research. So it is also available for study of human behavior, social studies, and it is also for statistical research. It is also for statistical research. Advancement of knowledge in the field of applied science, natural science, social welfare, and statistical research. Am I clear? Okay. Now, friends, these expenditures are divided into two: in-house research expenditure, where I have a R&D department within my organization and I do my research. I might or might not have R&D. I contribute to an external agency, approved agency, for research purposes. Am I clear to you? So divide it into two. Okay. In-house research expenditure, contribution to external agents. First, let me talk about in-house. All revenue expenditure of the previous year. This is allowed, and for this, I don't need a section. Obviously, all revenue expenditure will be allowed. All capital expenditure of the previous year. So, this is the benefit, that instead of claiming depreciation, I can claim the entire capital expenditure as the deduction, where current year is the first year of operation, then revenue and capital expenditure of the past 3 years can be accumulated and claimed in first year. So I start my research first. After 2 years, I start my company. So the 2 years research expenditure which I have incurred can be accumulated and claimed in the first year of operation. Only one deduction which is not allowed, not only in this section, all through section 35, you will see cost of land is not allowed as deduction. 100% of amount contributed 100% of amount contributed. Hundred percent of the amount contributed to National Lab, IIT, IAM. The word approved need not be there because all these are government. National Lab is government, IIT, IAM. And then approved scientific research association, institution, educational institution, and universities. Any public limited company whose main object is research. Am I clear? Okay. Cannot be claimed under concessional tax regime. What cannot be claimed, Archana? What cannot be claimed? What cannot be claimed? Only contribution to external agencies. Friends, in-house research can be claimed under both regimes. Let's be very clear, because in a fast manner, some I've seen even books writing section 35 not applicable for 115 or concessional rate. No, that's wrong. Section 35 has two parts. In-house research still can be claimed under concessional tax regime. Only contribution to external agencies cannot be claimed. That's why we have written it this side. Remember, only contribution cannot be claimed. Okay. Am I so far clear to you? Okay. I'm just giving you an example. Today, on 10th of October, I gave to a scientific research association 10 lakhs, approved institution 10 lakhs. I'm under the old tax regime or Finance Act tax regime. Can I claim? Yes. On 1/1/26, approval withdrawn. The government withdraws the approval on 1/1/26. For the financial year 25/26, can I still claim it? You understand the question? The answer is yes. On the date of contribution, I believed they are an approved agency and it was there in the list. Subsequently withdrawing will not affect my expenditure claim. They will pay tax because all scientific research association enjoy section 10 exemption till the approval is there. Once the approval is withdrawn, they will pay tax for this. But for me, the deduction will not have an impact. Note 1. Where the approval is subsequently withdrawn. The deduction can still be claimed. In other words, subsequent withdrawal of approval will not affect claim of deduction made earlier. Approval of the ministry is essential for in-house expenditure, like what expenditure you are incurring, etc. You need to project it as a project. You need to present it as a project, okay, and get the approval. Friends, I purchased a plant and machinery for research. Okay, let's take some 10 lakhs. In-house research, I purchased the plant and machinery. Is it allowed as deduction? Yes, 100% I would have claimed it. Now the research is over. Now the research is over. Okay. Or the purpose of the plant and machinery is achieved. I have two options in front of me. Directly sell. Okay. After the research is over, directly sell. It will be treated as income. Whatever is the sale value will be treated as income. Whatever is the sale value, we'll treat it as income. Transfer it to block. You are not selling it, you are transferring it to block. What value can you record? What value can you record in the books now? In the plant and machinery, addition, asset transferred from scientific research. What can be the value? That's what she was saying. Hmm? You need to find out the WDV. Okay, let's take that the WDV comes for example, some 7 lakhs, some 2 years, 3 years, you depreciate it, comes for 6 lakhs, and you will claim 15% on 6 lakhs. Is it fair? Already you have claimed the entire 10 lakhs. Now you are again claiming. So what value will you record? You cannot record any value when you are subsequently selling, block value reduces. You cannot record any value. Am I clear to you? Am I clear to you? Okay. I'm asking you to go back to somewhere we left some space and came. I said we will fill it up. Okay. Asset used for special cases of addition. We did a table. I asked you to leave 2-3 lines. Okay, to write 2 more cases. One of the case writing. Asset used for scientific research now transferred to the block. Clear? Clear? Okay. Post research scenario. Post research scenario. Two falling branches. Asset directly sold. Asset transferred to block. Sale value will be treated as business income. So I told you gain is also taxable. Some asset sales is also taxable in this chapter. This is a sale of asset, but it will be taxable under. I'll again explain you why when we go to section 41. Sale value will be treated as business income. If sale value is over and above original cost, such excess is capital gain. Value recorded in block is nil when subsequently sold. It will reduce the block value. In our format, deletion, sale value of the block. So automatically my depreciation will come down on the remaining asset, because for that asset no depreciation. On the it will reduce the other assets balance. So my depreciation will read through, friends. Read through once the scientific research. Can I? Okay. I'm leading you to page number 18, question number 15. The following are the details of Orchid India Limited, engaged in the business of manufacture of pharmaceutical products for the year end. Sales, manufacturing, administrative, selling and marketing, finance, assets purchase. Charges paid for acquiring know-how. It is an intangible asset, my dear friends. 25% is the rate of depreciation. Plant and machinery purchased and put to use in May, put to use in December. Research and development for in-house training, in research expenditure, remuneration, expenses, contribution to approved scientific research institution, national lab, university. The company has opening WDV 40 lakh. The company had spent during the year 22 lakhs for lab construction for research purposes. The construction is not yet completed. Compute taxable income under the both regimes. And remember, in scientific research, as and when you incur the expenditure, you can claim. There is no put to use condition. Even this lab expenses for research, you can claim. Okay. First, read the question once, we will do it. Leave some 10 lines and come to working note. Leave some 10 lines and come to working note. First, I am doing depreciation. That's correct. Normal? Ah, 11 lakh? 65 lakhs into 7 oh, and 75 lakhs into 15%. Yeah, 11 lakh. This is 1350, right? Is this correct? Yeah. Working note to scientific research expenditure. Is the totals also right? Now let's go to the main answer and do. I'll wait if you're ready. Under old regime, what is the depreciation? All the three you can claim. Normal plus additional. In the old regime, and in the new regime, here it is 1 lakh, 1 crore, 1 crore, right? 52 lakhs. Here 1 crore 22 lakhs. One 225, 225, 248. 4 crore 80. check it out. Always our institute expect us to, at the face of it should be answer followed by working. $500. So here also it changes. 4,35,87. 12,500 it should be. Shall I? A Limited, engaged in manufacturing, furnishes the following particulars: compute the deduction available while computing its PGBP if it does not opt for concessional rate. So, amount notified by approved institution 1 lakh, IIT 250, amount paid to a company whose main object is research, revenue, capital. So just the addition, I'm not wasting your time, just the addition of these things. Okay, part of institute study material question. Okay, this institute study material question will be very simple, that somebody prepares. In all other subjects I heard the institute study material questions are too good. DJ used to say that if you do institute study material, that's sufficient. In our subject alone, I don't know why questions are so, you will see as the class goes by, so simple question. I don't know why, but there is no relationship with the exam questions that is asked in. And yesterday also, our friend Bilal asked me whether all the past year questions are incorporated in the material. Yes, it is incorporated. I don't have the habit of writing the year, etc. It is incorporated. But I want to give one additional answer. It's of no use. Reason is, see, static subjects, you can take the past question papers and answer. Dynamic subject, it changes every year. Only God's grace nowadays 3 attempts. Okay, a financial year. Okay, what is the use of having, if you, I always feel that if you see a suggested answer, the answer might be, computation of tax might be completely different. And within bracket, if they just give the answer, you will go haywire. The answer you get, and that will be two different. Okay, so in tax alone, there is nothing called past year question paper. Every year is a new year, fresh. Okay, but still, whatever adjustments are there, incorporate. Question number 17. Swastik Chemicals has a research department and maintains registers pertaining to that department separately. The company had purchased the research equipment in the past year for 14 lakhs. Since the research process was completed, the company intended to transfer the same. The equipment has the present market value of 16 lakh. What is the tax treatment in the following cases? Case A, if the equipment is directly transferred. Case B, equipment is transferred to the block and sold. The WDV of the block as on 1st April, additions made less than 180 days. Same case C with different amounts. Case D, if the company is amalgamated with another companies and these equipments are taken up. Patiently read the question. Shall we, friends? Okay. Where it is directly sold for 16 lakhs. Up to original cost. In the second case, the block is gone. The block is gone. One lakh 180. Vijay, you're understanding? You're getting it? Srinidhi, you are following? Yeah. The transferee company will take over the asset at nil value as the transferor has claimed 100% deduction. Okay. Okay. This words will going to repeat. Provisions will apply to the transferee entity as it would have applied to the transferor. So if the transferee entity, the amalgamated company now sells they are not going to use the asset for scientific research. They have two options. Either sell directly or to transfer to their block, record the value as nil. Same options are there as if the event has not happened. Whatever would have been, in all provisions it is the same. Like depreciation, I can take only the value of the previous entity. In all provisions it is, because in many questions the last part of the question is, if it is amalgamation, what happens? Okay, so this is the answer which we will be writing. Am I clear to you? This is section 35. We'll go to 35 AD on Sunday. Meet you on Sunday morning. All the best. All the best, online friends.